My name is Anthony Chicumba. I'm a senior research analyst here at Loop Capital Markets, covering specialty hardlines retailing. I am joined by my fintech analyst, Hal Getch, and we're here to talk about a subject area that gets a lot of press, and there isn't necessarily a great amount of understanding, specifically, crypto, DeFi, Metaverse, a bunch of other buzzwords, but we're really looking at it from the perspective of equity investors. So for investors who aren't necessarily sort of crypto or digital natives, what does this sort of all mean? And we've got a great panel, and I think we're gonna have a wonderful discussion about this. So I wanted to start off by, aside from welcoming you all, introducing our panelists. Our first panelist is Paul Su. Paul is the founder and CEO of Decasonic. Decasonic is a Chicago-based venture and digital assets fund. They specialize in blockchain, DeFi, gaming, metaverses, non-fungible tokens, and decentralized autonomous organizations, whatever the heck that is, as well as Web3. Paul has worked in the technology industry since the late 90s. He's a very well-recognized industry thought leader, particularly in terms of emerging technologies. He previously worked at Zynga, where he was a product and growth executive there. He spearheaded several user retention and monetization initiatives, including in-game virtual currencies. So to some extent, that was kind of like the first crypto when you think about it, as well as free-to-play virtual goods, kind of sounds like NFTs, platform currencies, and other digital assets. Prior to Zynga, Paul was a founding member of NeoCard, a $300 million technology venture fund. Full disclosure, Paul and I used to work together in investment banking in the late 90s at Merrill Lynch. In addition, we have Basel Ismail. He's the CEO of Block Circle. That's a market-leading quantitative crypto and NFT market analysis and data intelligence company. They provide consulting and advisory services to global companies in a number of areas, including data science, financial technology, information security, blockchain, crypto, financial engineering, and product development. Prior to he's also runs Build More Digital, which is a multi-venture company that owns and operates digital and physical properties. Prior to these roles, Basel was a director of project engineering and data science for American Express. He also worked in consulting for corporate services and real estate for Goldman Sachs. And then last but not least, we also have Nathan Dean. Nathan is a senior policy analyst for Bloomberg Intelligence, which is a research platform that provides context on industries, companies, government, litigation, and the economy. He covers Congress, the White House, and regulatory agencies, including the Federal Reserve, and their impacts on capital markets. Before joining Bloomberg, he worked in the government affairs departments for the CME Group and Bank of America, where he focused on the implementation of the Dodd-Frank Wall Street Reform and Consumer Protection Act. He also served as an expert for legislators, policymakers, and regulators on the impact of government policy on the financial services industry. So I want to thank or welcome all of our guests and our panelists, and thank you so much for taking the time. So let's jump right into it. And anyone who knows me knows that I really don't pull a lot of punches. Let's keep it real here. So first question, and this is going to be for all of you. Maybe we'll just go in the order that I introduced everyone. But on a scale of 1 to 10, with 1 being not at all and 10 being a house on fire, how concerned should traditional financial players such as commercial and investment banks be about the growth of cryptocurrencies and DeFi, and also why? So why don't we start with you, Paul?
Anthony, Hal, thanks for having me. On a scale of 1 to 10, I'd say it's 11. That the house isn't just on fire, the neighborhood's on fire. TradFi should pay attention to what's going on in crypto, as blockchain use cases are transforming finance today, similar to how the internet transformed retail bricks and mortar. Anthony, I know you're very familiar with that story. We're seeing the same disruption happen today.
Talk.
Basel, what are your thoughts?
So no, I completely agree with Paul. I mean, there's clearly a digital revolution that's happening right now. Institutions are crossing the chasm from Web 2 to Web 3. And I think the financial institutions have an opportunity to be able to hopefully catch up. And new financial institutional infrastructure is being started up from first principles up. So a completely new technological foundation is being created. And the financial institutions, the majority of them, commercial and chartered banks included, are still using the legacy, outdated, and incredibly antiquated, financial infrastructure. So the opportunity is there. I think even if I think they still have a good opportunity to catch up. I would rate it as a 10, to be honest with you. So yeah, it's happening very fast, very rapidly.
Got it.
And I would just say, I would probably say a 6 or 7. And the only reason why I'm a little bit less than my colleagues is that, traditional finance will always have a role over the next few years, in my view. But cryptocurrency and this DeFi and so forth like that, traditional banks, commercial banks, investment banks, they need to understand it. They need to look at it. They need to follow it, because there may be an opportunity the next 3 to 5, 7 years where they want to jump in. It's either because their clients are demanding it, or just chase for specific example. Let's just say the Fed creates what's known as central bank digital currency. Well, if they do that, they're going to need existing banks, digital wallet providers, existing companies to administer that. So it may not be today that these commercial banks or investment banks want to jump into it, but it could be down the line. And so you definitely have to pay attention to it.
Got it. That's very helpful perspectives. So I guess my next question, somewhat related, maybe it's a bit more cynical, but how do you respond to those who say that cryptocurrencies are only useful for nefarious purposes, such as money laundering, ransomware, or buying illicit goods on the dark web? I mean, Paul, what are your thoughts on that?
I would say many of those people are Luddites. Those are also use cases done in traditional banking, cash, or other offshore activities. While this might have been a use case a decade ago, these crypto skeptics are blind to the 300 million crypto users today and the many use cases around financial inclusion, financial empowerment, and digital gold that have evolved in the last decade. Transparency in today's blockchain has enabled better tracking of those nefarious use cases. And generally speaking, we're seeing the explosion of positive use cases in our sector.
Got it. Basel, what are your thoughts on that same question?
Well, I mean, this is often a challenge I get from clients, right, and from different companies who are exploring the space. And I just look at everything as a data scientist. So I let the data speak for itself. I look at it quantitatively. If you look at total amount of money laundering happening in traditional markets, it's roughly around $1 trillion. If you look at total cumulative calculated money laundering happening in digital assets and cryptocurrencies, all inclusive of everything across all 15,000, it's around 30 billion since 2017. So, right. So you're looking at the last 5 years or 6 years. That's where you're looking roughly at it. So then you look at the ratios. You look at the percentage of money laundering financial transactions relative to total amount of volume that's been transacted. In digital assets and crypto, it's less than 0.05, even less than 0.04% of total transaction volume. If you look at traditional markets, money laundering comprises more than 4 to 6% based upon like the latest estimation based upon my own calculations. And so, I mean, you're looking at a 1 to a 100x kind of difference, right, between traditional and cryptocurrency money laundering. So I think though that data refutes any claim and any claim that of the alternative. So
fair enough. So one thing that I have very consistently heard is that crypto mining uses a ton of energy, and thus it's just environmentally unfriendly. So how much truth is there in that statement? And how is the cryptocurrency ecosystem addressing these concerns? Maybe Paul will be interested in your thoughts on that question.
Absolutely. It's a partial truth. Older generation crypto mining can be energy intensive, but the newer technologies, especially those in the last 5 years, are tremendously energy efficient. A lot of entrepreneurs enter crypto to solve these key bugs. Energy efficiency is a key bug today, and we're seeing accelerated innovations in this area.
Got it. Nathan, what are you hearing?
Yeah, so if you go to the Bitcoin Mining Council, they actually publish data on their sustainability usage, and the sustainability usage is actually increasing every quarter to the point where it's already passed the United States as a nation. And this is something that the crypto lobbyists love to put out in front of the policymakers, because when we look at mining companies, we actually assign them a very low policy risk, and because A, the sustainability usage is increasing, but B, let's just say if you're in the state of New York, and the state of New York right now is debating a bill that would pause crypto mining for 2 years. If you don't like it, you can just pick up your toys and go to Wyoming, or you can go to Texas. This is what we saw when China did their Bitcoin mining. A lot of that came to the United States. So when we look at crypto mining, as long as you have that sustainability usage increasing with the lack of a policymaker response, this is something we think the industry will figure out over the next few years.
Got it. So, when you think about cryptocurrency, you also think about, decentralized finance, the blockchain, probably a few other buzzwords. I guess my question is, how does the growth of decentralized finance and blockchain fit into the larger theme of Web3, NFTs, the metaverse that everyone seems to be fixated on right now? Maybe we can start with Basel on that.
So what I was mentioning before, right, is a digital revolution is happening. So DeFi is part of a larger Web3 transformation. So, Web3 is the first opportunity to be able to be a network participant as well as being a network owner in what you're contributing and creating as content in terms of everything that you do within that network. So if you model out those network effects, I think it's pretty significant. It's very clear where the momentum is and where the trend is, which is everything is shifting to a more transparent, interoperable, flexible, and adaptable world. And that's Web3 allows you to do that. The beauty of Web3 is it now allows you to start decentralizing any form of previously centralized, group of services. So that's where the metaverse comes into it. We spend the majority of our time in a virtualized world. We spend the majority of our time on Zoom and all of the other, video conferencing alternatives. We use Skype, we use Telegram, we use Discord, right? Those are all messaging platforms that are all being housed centrally using central servers. So they're all being centrally censored and governed and controlled by some type of central corporation. That's all Web 2. Web 3 is the next step across that continuum of adoption, and it's now decentralizing it. So now there's alternatives that are being enabled, and everything is being housed in a decentralized Web 3 world. So it's just like the next logical step across that the growth curve and the adoption curve. So that's Web 3, that's Metaverse. And then there's other alternatives within, other components within Web 3 that are very, very interesting for me personally, like play to earn, move to earn. Those are all ways where you're essentially introducing game theory, and you're introducing some type of gamification of your day-to-day function. So, if you can be incentivized by a company to move and be active and be healthy, and then you can be rewarded in terms of actual tokens that you receive in your own wallet, right? So that's a move to earn or a play to earn kind of concept. So there's a lot more on that, but that's the general gist of my view.
I love those comments, and extending on some of those thoughts that Basel just shared, that there's such a tighter platform growth alignment with user value proposition. And for a tech investor and ex-product executive like myself, that this is such a tremendous breakthrough in our society. Anthony, to your specific question, DeFi is powering new Web3 business models. How we think about embedding borrowing or lending into your digital activities is such a transformative moment in our digital experiences today. At Zynga, we invented free-to-play gaming, and that was revolutionary in Web 2. In Web 3, you're starting to see more governance and ownership models around decentralized finance, DeFi, around NFTs, around activity that enable financial empowerment. And echoing some of the earlier comments, that this is just the new design space that a lot of entrepreneurs today are building.
Got it. No, that's helpful perspective. So, one thing that I've heard about, transacting in crypto is that the transaction fees for buying and selling different cryptocurrencies are very high, particularly relative to more traditional financial instruments. Why is this? And more importantly, what has to happen for those fees to decline over time? Paul, what are your thoughts on that?
Why is it? Because it's an emerging asset class. Retail investors are okay paying the additional fees for ease of use, for custody, for services. This is the Coinbase value proposition. Advanced users can essentially trim these fees down to near zero. If Nathan and I transact peer-to-peer, that there are no fees, and this is not possible if he and I want to transact Apple stock peer-to-peer. And so generally speaking, you do see expensive fees for retail investors. As people get more advanced, you see those fees come down. What declines this over time? Competition. Jim Chanos over the weekend announced his large short position on Coinbase because of this exact issue. Competition will come from Binance and FTX and other competitors who see that margin as an opportunity to capture market share.
Basel, what are your thoughts on that same question?
Yeah, I mean, I agree completely with everything he said. I mean, that's exactly my view on it as well. It's a compromise. I mean, they call it the blockchain trilemma, right? So it's really a challenge between scalability, transparency, security, and it depends on what platform you're looking to execute a transaction on. So if you are willing to compromise safety and security to an extent, then you use a centralized cryptocurrency exchange like Coinbase, Gemini, Kraken. Those are all regulated and approved and licensed to be used and insured to an extent within the United States. If you are not willing to compromise security and safety and you want to do peer-to-peer truly in the way that Paul defined it as, then you would venture out and use decentralized cryptocurrency exchanges, but that comes at a significantly higher cost of execution, of settlement, and there's really no level of arbitration that can be done. So it comes with its own set of challenges. But that's layer one. Now there's layer one is essentially the ground foundational layer of blockchain platforms like Bitcoin is layer one, Ethereum is layer one, Solana is layer one. But now in the advent of layer two settlement technology that runs on top of layer one technology, that is rapidly improving scalability. It's rapidly improving transaction processing volume and the throughput and the bandwidth. Everything has exponentially increased because of those layer two platforms, right? So there's Matic, there's Matic/Polygon, there's dozens now of layer two settlement platforms. And as those continue to rise in popularity and adoption, the transaction fees are gonna plummet. That's one big movement. The other big movement, the trend that's happening is Ethereum is still layer one, and it's still using a governance rule called proof of work, right? And that's incredibly expensive and it's very computationally intensive. So that is now moving over to something called proof of stake. And that's really, just think of it as an operating system. It's going through a huge operating system upgrade. And when that happens, hopefully in the next 90 days, fingers crossed, transaction fees are also going to continue plummeting and potentially become a deflationary, economy, right? So there's a lot of really good moving trends that are going to continue dropping transaction fees in a decentralized way and remove the reliance on centralized exchanges.
And I would just briefly add that transaction fees is something that we see as a phase two regulatory risk. So something that's probably going to be out 3 to 5 years from now. I'll talk about phase one more later in the panel, but this is something that regulators, not just for crypto, but just for everything that's happening at the SEC right now, the CFTC and so forth, transaction fees, retail fees, disclosures, transparency. This is something that the industry is going to have to deal with 3 to 5 years from now, once they get through phase one and the regulatory uncertainty they're going through at the moment.
Well, Nathan, that actually segues really nicely, because I wanted to kind of switch gears a little bit and start talking about policy stuff. And I know that's really kind of one of your areas of expertise. So I guess let's start off. What are your thoughts on the implications of President Biden's digital assets executive order for cryptocurrencies and DeFi? Is this significant? Is it, kind of a nothing sandwich? Like how should we think about that in the broader context of the conversation we're having right now?
So there are good things and there are bad things associated with this executive order. So back in February, President Biden made an executive order. Just please remember, executive orders only apply to the executive branch. So it's only things that he can control. And what he did is he asked the government to come back and various agencies to come back and produce reports. These reports will be out between August and October, right before the election. So unfortunately, they're not going to get a lot of press cycle. However, in these reports, they're going to have recommendations for regulators to implement, regulations for Congress to implement. The bad things here is that Congress can effectively ignore the executive order. Regulators take lots of time. Rulemaking usually takes 2 years to put into fruition. But the good thing that is happening with the executive order is that it's a foundation for regulators and policymakers to move forward on for the next few years. This is the first time you've seen a large group of regulators actually come together, or agencies come together and start talking about this stuff. There was testimony from the Fed last week that the working groups have actually just started to say a month ago. So these reports are going to come. These reports are going to have recommendations. Will they act on them? Not entirely. They'll certainly act on some, but it's a good foundation for policymakers to move forward with and actually start providing some regulatory clarity over the next few years.
If you don't mind me jumping in, Nathan, 100% agree. That regulatory clarity enables founders to build what Biden called responsible innovation. That clarity enables Basel, myself, and others to at least address a fuzzy line of this regulation, stay pretty far away from it, involve policy makers, involve lawyers to build new innovations. And we saw that executive order as a major catalyst for our building. It catalyzed Gavin Newsom in California to issue a similar executive order. So you're starting to see the cascade of policy address some of this regulatory unclarity in blockchain.
Got it. Very helpful. So obviously we've got these upcoming midterm elections in November. Nathan, what are your thoughts in terms of how the upcoming midterms could impact the future of crypto policy, particularly if Republicans were to retake control of Congress? Would that be a positive or negative catalyst towards crypto policy, DeFi policy?
So ironically enough, the elections we think don't have much of an impact on crypto. What it means is that whoever controls, and let's just say the polls are suggesting the Republicans are going to take at least the House, if not the Senate, they're going to be the ones that are actually writing the legislation. Now, it is our view that Congress will pass legislation next year. This legislation will define what is a security, what is not. So if you're Coinbase or FTX, you're going to get some clarity there. There will be stablecoin legislation in there. Big thing to keep in mind later this week, Senator Loomis and Senator Gillibrand are going to release a bipartisan bill. That is the foundation for this legislation next year. It's not going to pass this year, but that's the foundation. But when it comes to the elections and when it comes to parties in Congress, we don't view this as a Republican or a Democratic issue. There are members of both parties that are fairly open to crypto. We view this as more of a generational issue. And so this will be something that you will see Democratic lawmakers and Republican lawmakers very skeptical of crypto. They'll make statements, but ultimately we think we can get something done next year. It's just going to be the party that wins the elections are going to be the ones that are driving the legislation. And if the Republicans win, that means you're going to see things like more regulation by the Commodity Futures Trading Commission. It's a little bit easier than what you have over at the SEC. More principles-based regulation, stuff that the industry likes. So if the elections turn out the way that the polling suggests and the Republicans win, it's going to be a small positive for the crypto industry.
Got it. So Nathan, in your answer, you mentioned stable coins, and obviously, we can't do this panel without talking about what happened with Terra USD, right? So I guess my question, and I'll address to all three of you, maybe we'll start with Paul, go to Basel, and then Nathan, but how significant of a setback to the cryptocurrency ecosystem was the recent collapse of Terra USD, and what can we learn from what happened with Terra USD? Paul, why don't you kick that off?
It's a significant event. but probably par for the course of any innovation. A comparable analogy to Web 2 would be the collapse of Terra is similar to demise of MySpace. We were monitoring these events over the last month. We're seeing limited contagion outside of the Terra ecosystem. A lot of VCs who held Terra were sitting on large unrealized gains. So largely they've been unaffected. What this does point to is the need for regulation, especially retail investor protection. And obviously Nathan is an expert in this area, but generally speaking, what we're seeing in the VC space is that this is, an innovation that failed, and builders will build back stronger, innovating on what Terra was setting the foundation for. New ideas will emerge from this.
Basel, what are your thoughts?
I mean, so I think it's probably important to define that, that there's 4 different types of stable coins, right? So there's fiat-backed, commodity-backed, cryptocurrency-backed, and then there's algorithmic-backed, right? So Terra was an example of a decentralized algorithmic stablecoin. It was largely experimental. It was very much in discovery phase. I agree with what Paul said around the significance of the event itself, but I still think of it as a learning opportunity for the wider market to understand the risks and consequences and the potential implications of having a decentralized algorithmic stablecoin. And the other thing that I think was a very good opportunity to learn was this relationship that it had with Terra, which is the founding organization. As a nonprofit organization, it had like a minting and burning relationship. So that was largely experimental, and I think it was very interesting. It's an interesting experiment, but I think it shows the inherent risks that come with algorithmic-based stablecoins, especially ones that are decentralized. That's one point. The second point is that I think it also is driving a huge amount of interest and I think intrigue and intellectual curiosity. I mean, to Nathan's point around, President Biden's executive order, I think the more interest, the more intellectual, brain power and curiosity is being pointed towards digital asset as a sector, I think is bullish, right, long term. So there's a huge amount of discussion and chatter around stablecoins for the first time in the history of cryptocurrencies. So to me, I think it's positive. It's also shifting. Now we have to shift that attention to MakerDAO as an example of an alternative stablecoin that is actually backed by a reserve of assets that are actually fiat denominated of US dollars predominantly, and also backed by cryptocurrencies with its DAI. So DAI is a very good alternative stablecoin that is not algorithmic. So, and I think, that's how I see it. Maybe I'm just biased and it's like a confirmation bias, but I feel like I love the interest, I love the curiosity, and I love the discussions about it. It's the first time ever we've ever truly spoke about stablecoins everywhere.
Nathan, what are your thoughts?
You said the word test case, and that's the same thing that can be used for the policymakers. Now, the collapse of Terra was not big enough to cause Congress to act. I mean, you would need something on the scale of the global financial crisis. But what it did is that it spurred conversation between Senator Toomey, who's the ranking member of the Senate Banking Committee. He's got some stablecoin principles and stablecoin legislation out there. Now, he's retiring, so it's not going to be around after the election. But he did get Treasury Secretary Janet Yellen on record to say that, something needs to be done and we need to work together on this. So, the conversation has started. And so that conversation will flow through to next year. And when we see Congress come together on legislation, it could be a combined stablecoin, token, security or not legislation. It may be separate. The Senator Loomis-Gillibrand bill is supposed to have some stablecoin provisions in there. So the conversation is going, and what they're looking for is safeguards, backstops, customer disclosures. Are you going to get something like FDIC insurance? Probably not, but at least it's going to be shored up enough that something like Terra, if it were to happen again, there'd be additional safeguards in place. Still disagreements, don't get me wrong. There's still big disagreements between Republicans and Democrats on what to do, but not enough that it would actually kill the legislation we think that can come together. Got
it. And with that, I'm going to turn it over to our actual fintech analyst, Hal Getch, not myself, who just plays a fintech analyst on TV. Hal, take it away.
Hey, Anthony, terrific job. Thank you so much. Those are some terrific questions. I want to get into some of the, the investing side of it for our panelists. Equity investors are in this conference, and equity investors look at all kinds of indicators. They have a dashboard in front of them. They look at like bond yields, the yield curve. For crisis, they look at the TED spread or the VIX. We have hundreds of quotes on our screens, the stocks we follow and other stocks we think are related to it. What are the indicators we should add to our daily lives as investors to track this space, and how do we use those KPIs to help us make decisions about the health of the crypto industry or blockchain as well? Paul, anyone have thoughts on that?
Yeah, I'll jump in, but of course, Basel's analytics background might add additional perspective too. The three we look at would be number of wallets, total value locked, and number of crypto users. And again, generally, I'm a fundamental investor rather than a trading metrics investor. A lot of these metrics are available on nassen.ai or glassnode.com. Total active wallets for Bitcoin today stands just shy of 1 billion. Daily active wallets for Bitcoin is about 1 million, and it's traded off about 20% or declined about 20% in the last year to date. Monthly active wallets for Bitcoin is about 16 million. By comparison, Ethereum total active wallets 151 million. Daily active wallets for Ethereum 500K, and monthly active wallets for Ethereum 6 million. Total value locked is a proxy for how much money is held up in the DeFi ecosystem. 111 billion sourced from DeFiLlama.com, down from about 200 billion pre the Luna event. Lastly, we track crypto user adoption. Nathan mentioned the generational differences in crypto adoption. This is accelerating among younger generations, among non-privileged citizens of the world suffering from hyperinflation. So we're seeing a lot of adoption in South America, Southeast Asia, geographies outside of the US. Today, that stands at about 300 million, about 30 to 40 million in the US. And as that continues to grow, tracking to the internet, we remain bullish about the long-term crypto adoption and Web3 adoption.
Okay. Yeah, and from my perspective, it depends on how much detail you want to get into here, right? Because we track hundreds of metrics on a daily basis, but the major ones Paul mentioned are exactly the ones we track as well. So total number of transactions being processed by leading layer one blockchain platforms. That's one. Second is total value locked by blockchain and by leading protocol within each blockchain. And then third is I spend a considerable amount of time tracking mining. So mining hash rate and mining difficulty. And what that means is the more amount of cumulative hash rate that you have that's dedicated towards the safety and security of the Bitcoin network, the more reliable it is. And it's also could be used as a very reliable direct predictor of the potential price. And it's very helpful to use for prescriptive and predictive analytics and modeling purposes. Another thing is the mining difficulty. So as the hash rate increases, level of difficulty and level of competitiveness increases, which hopefully reduces your mean block time, which means the amount of time it takes to actually process a block of transactions. So all of those things are tracked for at least Bitcoin and for Ethereum. I think that pretty much covers around 80 to 82, 83% of the entire market. Other things that we track, I spent a lot of time doing sentiment analysis. So, using like natural language programming and machine learning and artificial intelligence and being able to gauge like polarity. So general consumer confidence, general institutional confidence. Are people happy or sad? Are they bearish or bullish towards any one particular platform? That has been an incredible, reliable indicator of the direction of short, medium, and long-term trends of different markets and derivatives. So a lot of people don't spend time tracking derivatives. So, but if you track futures and you track the short, long, and the put and call interest based upon options, and especially around major significant expiration events like just happened yesterday, that's a very, very good predictor of whether or not you can see if the market's oversold or overbought, and whether or not it's stretched in either direction. So that's really what we do, and exchanges. So again, I'll let you stop me at any time, but I mean, I could speak to you about this for hours.
Basel, you mentioned something around sentiment, that if you type into Google, there's something called the Fear and Greed Index that,
yes,
you know, a lot of people will just buy the dip when there's a lot of fear and sell when there's a lot of greed. And that's a very simple ratio of, you know, put and call interest. And, you know, generally speaking, you can look at market bottoms and market tops with that index.
Yeah, if you want simple ones, you can look at Wikipedia article views for the cryptocurrency category, Wikipedia article views for Ethereum and for Bitcoin, and then Google search interest based upon popularity index of how to buy Bitcoin, how to buy Ethereum. Those are incredibly reliable, simple indicators that are available for everyone, and you can integrate it within, you know, any native system that you have.
And I would just add, if an equity investor is looking to invest either in a public or company or via the private markets into a private company, we would highly recommend just asking questions about what is their regulatory strategy, because there are many companies out there that just their regulatory strategy is just to put their head in the sand and hide. There are other companies that are seeking to work with regulators. Now, you know, we don't know where regulation is going to go. We actually advise scenario analysis. What happens if you do this? What happens if you do that? But if it's a publicly traded company, IR should have these answers for you. If it's a privately traded company, the executive team should have these answers for you. So it's just something to keep in mind when you're trying to figure out the policy risk of your investment.
Oh, okay. You know, we're following quite a few companies now at Loop Capital, and have some at our conference. They're involved in allowing consumers, fintech, we call them fintech-enabled platforms that allow consumers to transact or round up or buy Bitcoin. And we have PayPal, stock we cover, under stock mention is Block, Money Lines at our conference. They offer the ability to round up, purchase Bitcoin for basically mostly they're targeting younger investors. You know, PayPal also has about half of their volume peer-to-peer and business-to-business, business-to-consumers overseas. So how do you think these companies, how do you handicap these companies' odds of making money in transacting in crypto? What are your thoughts on PayPal might be launching a stable coin? And that's a really important thing. We'd like to hear from you on what do you think about PayPal in launching their own stable coin?
I'll jump in quickly. A lot of these fintech companies are providing new banking services for a younger generation. You know, when you grow up playing Minecraft and Roblox and Zynga games, you're just used to having everything being digital, now crypto native. So how these companies are you know, addressing those value propositions is through crypto and providing the full suite of banking services. You know, in many of these strategies, crypto could be a near-term loss leader to lock in those accounts, lock in those wallets to then upsell into other areas. A lot of these companies are managing towards a lifetime value that is certainly in the years, if not, you know, closer to a decade. So generally speaking, a lot of these fintech companies view their accounts that way, and now it's a game of how much share of wallet of a particular financial relationship these fintech companies can own. To the question about how do they make money doing this, well, Square Block is making money doing this. They reported 10 billion in Bitcoin revenues last year with a gross profit of 218 million. I think this year they're on a run rate to more than double this. So, you know, it's not that much of a loss leader, but you know, net, you know, positive to tremendously accretive to their lifetime value calculations per user.
Yeah, and from my perspective, I think it's inevitable. So those financial tech companies have to continue to adopt digital assets, and I think, thanks to inflation and rates going up across the board, their net profit per transaction is going to be higher because their expense base has not increased proportionally with their revenue base. So just thanks to the the PPI and CPI and really just general cumulative cost increases thanks to inflation, their actual net transaction processing amount has increased. So that's going to improve their bottom line and improve ultimately their profit. So that's one. Second point is that I think this trend is not going to discontinue. So we haven't spoken at all about like yield management. So there's what these companies are doing now, and especially cryptocurrency exchanges are leading the pack, where they're hoarding as much stable coins as possible. And the way that they're making positive returns off of that is they either lend those stable coins out to other institutions who are producing some type of positive yield on those assets. And then you as a user or as an institutional corporate account of those exchanges are receiving some type of reward, right? That's below what they're receiving in terms of their lend rate. So that's very good for them. So if they're able to secure, let's say 8% yield on $1 million, they're going to secure back maybe 3%, 4% back to you, and then they'll pocket the difference. So that's one big thing. And I believe PayPal is going to do that. So I think they realize that we're in a negative real rate kind of environment right now. We can see like purchasing power is eroding. It's clear that's the trend. And I think that what they're ultimately trying to do is accept any form of payment humanly possible that is backed across any form. So Web 2, Web 3, etc. And I think eventually they're going to offer some type of yield generating / liquidity providing service for all users, retail users and institutions. That's my suspicion. That's what I predict, but I believe it's inevitable that they're going to do that, as well as banks are also going to do that as well.
Anything, you have any thoughts on the?
Yeah, so really two thoughts. One is that the regulatory changes that are coming over the next few years are not going to be industry killing. We call them industry altering. And it's the companies like that have legal risk, compliance, expertise that are usually the ones that actually succeed. It's the small mom and pops or those who just ignore it that are somewhat, that have a difficult time going through the regulatory framework. But one of the things that we're seeing in the crypto space is that those larger companies that try and launch new products or launch new innovations, so forth, they're willing to take risks because they can sort of identify what regulatory issues are coming. And what I'm thinking here is fidelity and the ability to include Bitcoins into 401ks. That is not something the Department of Labor is entirely comfortable with at the moment, but Fidelity made that decision that it was worth the risk to go forward because they've done their research, they've done their homework, and they think they can get it through. So when it comes to large companies launching new products or so forth, again, it could be a large company, it could be a small company. All I ask is that, if there is a company that has risk, legal, compliance that takes this seriously, they're usually the ones that you can get through that regulatory change fairly easily, or at least survive.
Okay, great. Thank you, Nathan. We want to get your guys' opinion on how investors should think about valuing Bitcoin or Ethereum. What are the thoughts you have on how investors should think about what it's worth over time? We're not asking for any near-term price targets or anything like that at all, but think about how investors out there value what a Bitcoin is worth, what it can be worth over time, because that's really important for a lot of long-term holders of Bitcoin who aren't trading.
I can take a stab at the initial. Typically when you look at valuation models using traditional equities, you typically would use the total enterprise value, which comprises of the market capitalization, the debt capital, the preferred stock, etc. But when it comes to digital assets, you really don't have that. You don't have any purview or insight at all into any of the tokenomics beyond what they are willing to disclose. So each instituting digital asset company doesn't have to operate they don't have a fiduciary responsibility. They don't have to operate within shareholder and financial disclosure requirements. There's no institutionalized based protocol and compliance around how those tokens are issued and shared. So you really have to rely on like comparative based valuation. So if you look at Bitcoin's valuation, it's X amount. And then from there, if cryptocurrency A is potentially extracting 5% market share of Bitcoin, then potentially that's going to be its valuation, right? So it's challenging, but the way I personally do it is I like to look at like network effects. So I like to look at what's the average amount of transactions that are being processed on a weekly basis, multiplied by the number of average weekly users. And if you do that across the main blockchain platforms that have this data available, you'll get pretty close to where we are now. And then you'll keep seeing oscillations where you see the valuations go above or below, what that continuum is. But that's definitely one way. And I think it erases all the noise away and it focuses just on the fundamental metrics of adoption, right? And that's empirical data that is not skewed or biased in any way. It's actual users on the platform and how much is their actual transaction value being distributed and being shared between users. And that's the way I would look at it. So, I mean, if you look at like the S curve of the internet adoption for the last 30 years, 40 years, it was very much clearly pointing up to the right. And it's exactly what's happening with digital assets. And we're on a very similar stage. So if the number of users and the network continue to grow, then the network effects are going to continue to grow proportionally with the valuation. So that's my view.
Your metric there was weekly average users times the value transacted. Is that what
the weekly amount of transaction value that's processed by blockchain? So Bitcoin will have one, Ethereum will have another, Cardano will have another, because then you'll immediately see is the amount that's being transaction, is it purely for mining or staking, or is it actual settlement of transactions?
Right.
So. Mm-hmm.
Just adding on here, two quick concepts. A great data source that maps digital asset financial metrics to traditional Wall Street metrics is a service called Token Terminal. And many people do look at that for price to sales, price to earnings. How do you clean up metrics for a proxy for earnings? That's just a great kind of source of comparables. The second point I'll add on around network effects. Blockchain today is Internet 2000. We are on this trajectory to impact 5 billion users in crypto adoption. Regarding digital asset prices, if you're a long-term fundamental investor, you're looking at that adoption, you're looking at the headwinds or tailwinds that accelerate that adoption faster or slower than the internet. You're looking at developer talent, founder talent coming into the space. And then as a result, capital follows that talent. Crypto VC funding is 24x year over year. We're on another record pace in Q1. Track those metrics of how professional technology investors are looking at this adoption. And we're seeing exponential growth, similar to the network effect that we've unleashed in the last few years. And from all signs of those metrics, we're unabated in that growth. And now is a great time as the bear markets have dampened investor sentiment, as the Fed has shifted and sector rotated away from traditional Web 2 tech into Web 3 tech. That bifurcation of funds flow is presenting a lot of good opportunities for long-term fundamental investors like ourselves at Decasonic.
And one last thing, Hal, just that's a very important point around valuations with digital assets is it is definitely worth mentioning that a lot of the valuations you see across the entire sector it's really the speculative based value. So it's imputed value. A lot of it is not intrinsic value. That's important. That's an important point of distinction when it comes to traditional equities, where you have, their 10Ks and 10Qs, and you can use cash flow based valuations and all of the other valuation models that are out there. When it comes to digital assets, a lot of it is imputed value. So it's what we believe it is going to be worth in X amount of years, and we're very biased. So I'm basically disclosing I'm very biased, bullish towards the sector and towards
Basel. You just have conviction.
I have conviction. I just don't feel. I feel like the U.S. dollar is just going to continue debasing and devaluing.
So if I could just add one more thought, though, in terms of a policy thought, is that you've got 30,000 plus tokens out there at the moment, and the SEC takes the view that 95 to 99% of them are securities. Bitcoin and Ether are not considered securities; they're commodities, and as such, they have much less regulatory oversight. The fraud, anti-manipulation by the CFTC. This is something that's going to come up in this legislation next year. Is what is a security versus what is not? House Ag Committee. Several lawmakers put out this piece of bill that came out this year that created a new digital asset class called the digital commodity. And the idea here that's happening right now is that the spot markets would then go to the Commodity Futures Trading Commission. So when this legislation comes out, you really have to look and see, okay, which token am I investing in, or which token am I exposed to? And is it a security? And therefore would go to the Securities and Exchange Commission, which has a lot more tougher oversight, in my view, than if it was a digital commodity or a commodity, and then it would go to the Commodity Futures Trading Commission. The CFTC offers what is known as principles-based regulation as opposed to rules-based. So if I'm overseen by the CFTC, then the company that creates the token can create its own governance program, it can create its own rule book and so forth like that, offer that up to the CFTC, and as long as we're meeting the principle of the regulation, we're okay. If we're under the SEC, it's a lot tougher. So this is going to play out over the next year. So if you're looking at a specific token, is it a security? Is it a digital commodity? Is it just a pure commodity? That's really important to the growth in the future of these cryptocurrencies.
Okay, thank you, Nathan. And we don't have a whole lot of time, but I do want to make sure everyone has a good understanding of the simplest way of defining Web 3.0 for everyone. It's come up a couple of times, and I think it's still a little abstract for even me. I think Web 0.0 was like a walled garden, like in America Online to begin, and Web 2.0 was kind of a read-write. You could read things online, you could blog, you could send information to the internet, and Web 3.0 is about ownership and being very decentralized. And Web 2.0 is there's a lot of concentration in big companies, Google, Amazon, the big the FANG stocks, basically. I think about it, who really dominate Web 2.0. Web 3.0 is more decentralized. Help us really give us your best pitch on what Web 3.0 really is as we.
I would say it's the next evolution of the internet. So it's tokenizing the world. It's a token economy. True Web3, right? I mean, I'm using the actual canonical definition of Web3. It would not have Alphabet and Microsoft and IBM involved. It would truly be completely decentralized. So rather than relying on Gmail and Facebook and Twitter, which are traditional Web2 platforms, where they are the ultimate beneficiaries and controllers of your data, and they have complete oversight and control over your data. Web3, everything is housed within a decentralized file servers. Everything is decentralized from an inventory data standpoint, from an execution standpoint, from an application layer standpoint. So there's Web3 servers like Arweave that are very interesting, right? And there's Filecoin, which is an alternative to Arweave, where they have figured out a way to house all of your data in a completely decentralized way, which makes it potentially autonomously executable. It's non-erasable, it's irrefutable, and it's completely transparent. So you know exactly where everything is, how long it's been there. You see the full lineage, and you see the entire provenance from beginning to end, and it's pretty amazing. I'm like a huge Web3 buff.
To level it up, your definition works pretty well. I would just add that Web3 is the next generation internet that enables digital value transfer and ownership. And those two concepts are tremendously powerful for technologists like myself.
These explanations were great for me. I mean, all I would just say is that there's 535 members of Congress on Capitol Hill. I'm guessing probably about 20 of them know what Web 3.0 is. So I would just keep those simple explanations coming, and the policymakers will begin to understand.
Yeah. But one of my last questions is on the infrastructure of Web 3.0. When I think of, we often compare this to the internet and the S-curve adoption of the internet. One of the things that the companies that were truly part of a very explosive investment period in the late 90s built the internet. It was fiber optic companies like Corning. It was router companies like Cisco Systems. These were not well-known companies back then. There was fiber channel stocks that moved data between storage to computing power that became incredible stocks. And when we talk about building Web 3.0, what kind of companies are emerging that we should really be looking at in both that might be already public that are have a fast growing division, or private that we should really be looking at, because this appears to me to be there needs to be infrastructure and software built for 3.0.
So, I mean, examples of different companies at the absolute lowest foundational level is the protocol layer, which are some of the ones that we've discussed, like Ethereum, Bitcoin is some involvement with this, Optimism, Solana. We haven't spoken about Cosmos. Cosmos is very interesting too, around like the internet of blockchains, where I think that's also the future, where multiple blockchains are functioning and communicating with using a common language, and that's what Cosmos focuses on. That's one aspect. Another aspect are like the bridge companies, like Synapse and all of the wormholes and bridges that are connecting between blockchains. And then above that, you have like the infrastructure category, where you have different governance and analytics and storing, like Arweave and Filecoin, like we talked about. IPFS, right, the interplanetary file system. That's the common framework around how you house that data and how you execute on it. And then above that, you have the application layers, and there's countless examples. Like I'm sure you've seen like the Sandbox and Decentraland. Those are all capitalizing on the metaverse movement itself and creating virtualized worlds within a virtual universe, essentially, where you can have multiple virtual worlds that roll up to a virtual metaverse, right? So those are very interesting. And then there's NFTs like OpenSea and Rarible, but those are not truly, they're most people call them Web3, but really they're all centralized marketplaces that are housed on Google and Amazon Web Services. So, so it's that's one thing. And then the highest level is the access layer, which has the aggregators and different other applications that roll up to that level that are truly decentralized protocols. So yeah, those are examples. And then there's companies that are, so asking about equities, like Cloudflare is capitalizing on this, and they're trying to tap into Web3. Google is trying to tap into Web3. Amazon is trying to tap into Web3 by having blockchain as a service out the box offering. So those are different companies trying to capitalize on the trend.
There are going to be crypto native winners, and then also today's market leaders are embracing blockchain, and those who don't adapt to that may die by the wayside. JP Morgan last week announced a $300 billion transaction volume in overnight repo and derivatives trading through their internal digital assets platform, Onyx, and monitor that. That's such a transformative adoption by Jamie Dimon's bank, and we're seeing a lot of the enterprise use cases being deployed today.
And I would just add that there are really two elements of policy analysis or policy risk that makes a company risky in our view. And that is if you're based in the US, or if you are US transacting, and if you have access to a retail customer. Those are the two elements that usually puts you on an elevated platform when it comes to the regulators in terms of looking at it. So, if you're in the Web3 development space, or if you're non-consumer facing and so forth, we generally have a smaller discount for policy risk, just because those are the two elements the US are looking at.
Thank you. Anthony?
Yeah, with that, we're at the top of the hour, so so we'll leave it there. So thank you so much to Nathan, to Paul, and to Basel. This was incredibly informative. You know, my head's sort of spinning, but in a good way right now, and I feel like a little bit less of a boomer. So we will have a replay of this panel available. Please contact your Loop Capital representative and enjoy the rest of your day. Thank you so much, guys.
Thank
Thank
you.
you.
Thank you very much.